We are joined now by Larry Fink, BlackRock Chairman and CEO, in a Squawk Box exclusive interview. Good morning to you.
Good morning, everyone.
Lots to talk to you about. Company earnings per share of $7.52 that did come in above estimates. Total, by the way, and tell me if I'm wrong about this, in terms of the estimate though for assets under management falling slightly short of estimates. And so I think investors are going to be trying to grapple with both sides of this. How are you thinking about it?
Well, it was a tough quarter for the whole entire industry. The industry saw over $100 billion of outflows in equity mutual funds.
You had $24.8 billion in outflows?
We saw some real large de-risking in our index equity positions. We saw investors go from equities into low duration fixed income. We saw people run to cash. But overall, we had $34 billion of inflows in ETFs. We had positive mutual fund inflows at BlackRock, so it was more institutional. We saw huge movement from clients, right. A lot of churn, and it was just. I think the markets are showing that investors are confused, but overall, because of expense discipline, because of how we've navigated, our revenues were up 18% in our Aladdin business and our technology business. So overall, it was a good quarter, but I was disappointed in our net flows, but very explainable by some large de-risking.
But Larry, just to dig into that a little, I mean, you're talking about moves that happened before this most recent market chaos, because it was the end of the quarter.
No, but we saw huge outflows before the fall.
So people are much more nervous.
Oh, absolutely. I think people are there's a huge commentary that we're at peak earnings, that earnings can only get worse, which we could all debate that. You know, we believe we have a couple more good quarters in earnings, but there is that view. There's a view that there's, and I think we're hearing that in Europe more than the United States. Companies are having margin pressures because rising wages, which may be a good thing for the overall economy, but not as good for corporate profitability. And you're seeing modest inflation increases in certain finished goods, some of it in the United States because of our tariffs in terms of steel and things like that. And so overall, you're seeing more consternation, more fear.
That consternation, is that being felt? Do you look at the institutional side? You were talking about the institutions before, or is that a retail issue?
It's both. We did not see it in retail. We had net inflows, but the industries had outflows. Institutionally, there were just two or three.
When you look out at this quarter, from what you can already see,
we're not seeing much change in attitude. We didn't see any wholesale changes. I think this is more. I actually believe the last 2 weeks was more of a hedge fund phenomenon. We had a couple big announcements of hedge funds closing down. I think there was a lot of de-risking going on from the hedge fund community. In the last 2 weeks, we did not see big outflows from any of our large.
When you look at what's happened, this roller coaster ride of the last week or so, or 2 weeks now, what is that? And do you expect? I mean, we saw a note from Morgan Stanley just last night. They think we're moving into bear territory here.
Well, almost 80% of the stocks are in correction phase today. So I don't think that's something unique. You could just look at most of the stocks that they're in correction phase right now. So I don't think that's something
Correction's
new.
Not bad.
Harvey?
Correction's not a bad phase to be in because they can go back up.
We've had a marvelous 10 years.
Right. No, but you sound like you're talking about maybe a bear phase or a secular bear phase.
No, I actually believe the economy is going to remain strong.
Just inflation doves say that we're not seeing the wage inflation where it's risen to a level of to start worrying about at this point. You just said margins are being affected. Are we seeing margins negatively affected by wage pressures in corporate America at this point?
Well, no, I said more European companies.
Oh, European
companies.
So there's wage increases. We don't care if we don't care what happens over there.
You're saying margin pressures. It could be wages. I have not dissected.
Are there margin pressures domestically?
There is worry. I didn't say the market is correct. There are worries that we are at peak earnings, that we're going to see more margin pressure, that we are going to see some wage increases. Now, let's be clear. The index that we see related to wages is very skewed by when elderly workers who are the highest paying people retire, they're replacing them with younger workers who are getting less wages. And so much of that is masking the big wage increases in technology and other areas. So we're not...
Automation, too. I mean,
so there are big wage pressures in, I would say, some of the big professional areas that a lot of firms have to hire. So if you're in a technology firm, you have wage increases going on there. But it is being masked by this mixture of retirees.
Or do you get the feeling we're underestimating the inflationary?
No, not really. I'm not that worried about inflation at the moment.
That's the only thing that really gets out of hand, which causes the Fed to go higher than it thought it would have to go, which sort of chokes. I mean, as we've said a million times, you don't die of old age. Economic cycles.
We are seeing an economy that's growing at 3+%. We're seeing areas of where there's difficulties of hiring people. So I see what the Fed's saying, and I understand what the Fed's doing.
But is it possible that all those things are actually, just take them at face value as positive? Because if they don't cause inflation, then they don't turn into that cycle where we have to cool things off.
Sure, but the biggest risk that no one wants to talk about is how the tax law has changed housing affordability for so many.